G'day, ladies and gentlemen. In 2022, I thought it'd be fun to take a moment and actually review the top 10 Canadian stocks by market cap, because so many of us can just rhyme off the S&P 500 top weightings, those largest US companies, your Apple, Microsoft, your Amazon, your Google, your Facebook, Nvidia, JP Morgan, Tesla, heck, you even got Berkshire Hathaway in there, but you can't rhyme that same reason to the Toronto Stock Exchange. And I think that's kind of ignorant because those companies have actually prevalently outperformed the S&P 500 last year, and a lot of them pay a lot higher starting dividend yields than any of those S&P 500 top 10 companies. So if this is something that interests you, consider hitting that like button for this really level, nice, kind of relaxing BC background. I don't really know where this is in Canada. I'm outside of Toronto, but damn, it looks nice. So let's get right into this, folks, by kicking it off with these top 10 companies, and the very first top weighted, no surprise, being a tech stock still, obviously Shopify, guys. Shopify on fire. Actually, not the largest company as of today. Royal Bank took that position because we can see as of today worth 194 billion. Royal Bank worth 195 billion just as of today, by the way. But this list needs to be kind of updated, but it's relatively right. It's relatively right. Now, Shopify, guys, up 2,402% in the last 5 years. My goodness gracious. If I knew any better, I should have bought this one. I've looked at it many of times, and it just never tickled my fancy for the overvaluation that it sits at. Even today at a PE of 45.8 does not get me excited, but gladly, I do have some indirect exposure through the largest Canadian pure play real estate investment trust, being RioCan. They actually rent out the headquarters of Shopify to them, which is really intriguing to me. But obviously, RioCan not doing nearly as well in that same time frame as Shopify, so clearly I could maybe call that a mistake. Who knows? I still like my RioCan for that juicy cash flow. But let's talk about the Royal Bank. These Canadian banks, guys, banks, utilities, telecoms for Canada, I think are largely underappreciated because there really are only a handful of these guys. And considering our population growth is exceeding by percentage basis the US and India, I think it's really important to understand that these companies are the only places money can flow into, especially with our fast growing economy, guys. And take a look at the Royal Bank. In the last year, it is up 29.89%. Starting yield 3.5%, but you picked it up at the beginning of the year. It's likely closer to 4%, giving you almost a 35% return. That is absolutely absurd for a large cap company. And in just the beginning of this year, guys, look at this, just bumping up, week over week. Whether this continues or not is debatable, but I recently just started picking up the Royal Bank. Let's talk about Toronto Dominion Bank and maybe Scotiabank really quickly, and then we're going to talk about Brookfield Asset Management. Now, TD is one that I just started buying in my tax-free savings account. The chart looks very similar to Royal Bank. The reason that I think these companies do so well is in part to the fact that a lot of people buy index funds, and when you're just buying broader economy index funds like the S&P 500 or the TSX S&P, the money just largely weights its way down by these large caps. So the money just automatically flows in here. I feel like a lot of pension funds add money to these kind of stocks, so they're just very stable, good payers. And look at the last year, 37.3% on Toronto Dominion Bank, competing for the largest company in Canada right now with a great starting yield of 3.58%. A little ripe for a Canadian bank, but the PE ratio is only 12.8. I mean, these are great companies, which is why I didn't have a problem buying it at all-time highs. And Bank of Nova Scotia, really no exception here, 33% return in the last year. And just to give you, and this one has a 4.4% starting yield, by the way, but just to give you a quick idea, the VOO that represents the S&P 500 in the last year, guys, is only up 28.66%. And it kind of pays a dividend yield of like 1.5%, whereas these banks are capping in like 3 to 4%. So you would have done way better with those large cap banks. Like, just absolutely beautiful stuff. So let's talk about, bam, Brookfield Asset Management. This is one a lot of people called me out for not buying. But I mean, in the last year, guys, I mean, take a look at this, 56% return. Just super steady, stable uptrend for the last year. Really not the best starting yield at 0.86%. That doesn't really get me too excited. However, the reason I haven't bought into this is because I don't primarily understand the company very well. And what's really intriguing, with a $94 billion market cap, the only value that I see in it is it's in its actual assets, because it has $343 billion in assets against the total liability, which is their debts, right? $221 billion. Now, I've learned as an investor, especially looking at REITs, you don't usually want a company with more than 50% leverage. And this company has a lot more than that. However, if we minus minus the assets against the liabilities, they're sitting on about 120 billion. So if they sold all their assets today, paid off all their debts, they would actually be worth more than their market cap. So it almost seems like they're trading slight cheaply against their underlying asset value. However, what I do not like is in the free cash flow. The free cash flow has done nothing for the last few years. And when we take a look at that income statement, guys, even though it has been growing, their margins are not that appealing. I mean, they're sitting at about 15 to 20% margins, give or take there. And when we take a look at kind of the year over year, it's just, I don't know, it doesn't get me that excited, but a lot of people were throwing the stock at me, and I congratulate to those who picked it up because you guys have done very well in the last year. But even going on their website, when I read who we are, with approximately 650 billion in assets under management and an over 100-year heritage as a global owner and operator, we focus on investing in the backbone of the global economy. So it's a highly diversified company. I mean, 1,000 plus investment professionals, 150 operating employees, 30 countries, 2,000 investments globally. This literally sounds like a pension fund to me. Like, I don't know how I invest in this because I can't see where the future goes. All I can predict is the economies continue to grow, and I'm getting exposure to real estate, infrastructure, renewable power, private equity, and whatever the heck Oaktree is. Like, what the heck is Oaktree? I don't know what that is. Performing credit, opportunistic credit, sure, whatever. I don't know. I just don't get it. So if you get it, let me know what you think in the comment section below. So let's talk about some other ones. Canadian National Railway. I think this is a favorite of Buffett, getting some global diversification in the Canadian economy. The railways, they don't excite me very much, guys. The last 5 years, up 70%, drastically underperforming the S&P 500. Yeah, they're staple to society's very stabilized stabilizer for your portfolio because you're not getting that volatility with it. But I mean, it's fairly valued, 23 PE, $109 billion market cap. The railways don't get me excited, guys. Nothing crazy about that. So let's talk about Enbridge. The reason people get excited about Enbridge, which if you don't know, this company is a natural gas and utility provider, guys. Take a look at this one. This company is paying a 6.9% starting yield. Do you know how crazy that is to be a top 10 company with a yield that high? There's no top 10 S&P 500 company getting anywhere near close to that. But the problem with this in the last year, it's up 17.12%. Looks kind of stable, right? You'd be like, well, that doesn't look too bad. But when we zoom out, we start getting the real story that this utility is very volatile. And I always tell you that if you're buying utilities, try not to be buying them particularly for capital growth as much as you should be buying them for dividend growth and stable dividend income, like you would be a bond. Now, if I was a little bit more risk inclined, maybe I would swing trade this over the year. Maybe I'd do some options trading on it. But yeah, Enbridge, guys, doesn't really tickle my fancy as much either, because again, when we kind of go into the financials and we take a look at the free cash flow, it's not growing at any kind of crazy pace, just stabilized. Let's take a look at the income statement real quick here, guys. Yeah, just really nicely growing. It's kind of weird in 2020 because it did drop off, so we could tell it was hindered by the pandemic. And when we take a look at the actual revenue growth here, guys, in the chart form, again, not overly appealing. It's not like a Facebook or an Apple where we're getting that nice consistent uptrend, right? So let's just talk about a few more. Let's scroll through. What else we got on here? We got some more railways, more banks, a lot more banks. CIBC is just under that top 10, but I own all of these banks. I own Royal Bank, Bank of Nova Scotia, Canadian Imperial Bank, Toronto Dominion Bank. So I'm largely exposed to the financials, which again, sit in these top weightings. So continuing on, here's Couche-Tard, a real interesting one that I know PPC Ian, a huge dividend U.S. investor, was actually talking about and I think buying into, which is really neat. Manulife, another really big one. Suncor Energy, a huge oil company. We got gold companies in here with Barrick. TELUS, another favorite of mine, a telecom company. Not the fastest grower, but very stable, great dividends. Loblaws, food companies. Magna. This is an interesting one that I want to talk about because Magna International builds parts for like BMW. I think they even build parts to some degree for Tesla. They're just a huge manufacturing company. And if we take a look at the performance of Magna for the last 5 years, 82%, it's about an average return, not nearly as good as the S&P 500. Decent little yield here at 2%. In the last year, let's take a look at the last year here, guys. You know, it's up 18%, so it definitely did relatively good. I wouldn't say it did great, but it definitely didn't do poorly. But I found a company that I think is a much more intriguing way to own this, and that is with another REIT, a Granite Real Estate Investment Trust. I love these logistics REITs. These are warehousing and logistic companies that basically own the real estate that things like Magna operate through. And the fun thing about this company in the last 5 years, up 132%, in the last year, up 33.91%. Great yield. I think when I was buying this, it was over 3%, but I think they have over a 30% 100% exposure to Magna as their primary client. Now, that is a good and a bad thing because you usually don't want real estate being so exposed to one company. But considering the scope and the magnitude of Magna, I wasn't too uncomfortable buying it considering their second largest tenant is Amazon. So, and it's globally diversified, right? So these are kind of fun ways to think about large caps. Sometimes you can get exposure to large caps through smaller cap companies, collect higher yields, and sometimes even outperform those larger companies themselves, right? But scrolling through, guys, you can start getting a really good feel for the difference. I mean, you got Hydro One, a utility is doing a lot of communications. Dollarama's in here, guys. Metro, another food company. So we can see that the largest weighted companies are one tech stock, primarily Shopify. You got your banks, your utilities, your telecoms. The reason this being is because our Canadian economy is growing around this infrastructure. Very intriguing, very unique in and of itself. Maybe what I'll do is I'll start reviewing foreign top 10 companies. We can maybe look into Europe. We can look into China. I think that would be a really fun video series. If that's something that would interest you, let me know what you think in that comment section below. And again, consider subscribing for those future updates. But stay cool, stay awesome, and I look forward to catching you in the next one.